$381 billion. That is not just a number. It is a siren. While the world is drunk on AI hype, while the S&P 500 shatters all-time highs, and while retail investors chase the next meme stock, Warren Buffett has quietly sold more stock than at any point in history. He's now sitting on a mountain of liquid cash larger than the GDP of entire nations, more than Finland, more than Vietnam, more than New Zealand. Why? Is he predicting a crash? Is he senile? Has the game finally passed him by? Or is he preparing for the sale of the century? The critics call it fear. They say the old man has lost his touch, but they are looking at the finger pointing at the moon and missing the moon itself. This cash is not an accident. It is a weapon. And to understand how to use it, we must stop guessing. We must discard the headlines, discard the panic, and discard the noise. We must enter the mind of the Oracle.
You want to know why I am holding this mountain of cash? Sit down. Let me show you. I hear the whispers in the room. I read the editorials in the journal. They ask, Warren, why are you sitting on your hands? Cash is trash. Inflation is the silent killer. You are losing purchasing power every second you wait. It is a seductive argument. It plays on the primal human need for action. It plays on the fear that everyone else is getting rich while you stand still. But it is mathematically and fundamentally wrong. To the amateur, holding cash is passive. It is an admission of defeat. It is a sign of weakness. To me, holding $381 billion is not risk avoidance. It is aggression. To me, cash is a call option. It is a call option on every single asset class in the world with no expiration date and no strike price. Let me explain the arithmetic of patience, because the math has changed. For a decade, we lived in a zero-interest rate world. In that world, holding cash was painful. It was like holding burning coal. But we are no longer in that world. My $381 billion is not sitting under a mattress in Omaha. It is sitting in short-term U.S. Treasury bills. Do the math with me. At a risk-free rate of roughly 5%, this mountain of nothing is generating approximately $19 billion a year in pure interest. That is $52 million a day. That is over $2 million every single hour. While I sleep, while I play bridge, while I drink my cherry Coke, the cash pile grows by $2 million an hour. I am earning more from do absolutely nothing than most Fortune 500 companies earn from their entire global operations involving thousands of employees and factories. So, tell me again about the cost of waiting. I am being paid a king's ransom to have patience. I am being paid to sit in my office and read. Most investors feel a physical itch to trade. If they have money in their account, it burns a hole in their pocket. They mistake activity for achievement. They believe that if they are not buying the latest hot stock, they are out of the game. I play a different game. My game is capital allocation. And the first rule of capital allocation is this. You do not deploy capital just because you have it. You deploy it only when the math is overwhelmingly in your favor. Right now, the math is broken. And until it is fixed, I will collect my $52 million a day, and I will wait. I can afford to wait for the world to panic. Most investors cannot. There is another misunderstanding about this cash. People think this is money that belongs to me, or money that I borrowed from a bank. They do not understand the engine of Berkshire Hathaway. They do not understand float. Let me simplify the magic of the insurance business. When you pay your car insurance premium to Geico today, You give us $1,000, but we don't have to pay for your accident until next year, or maybe 5 years from now, or maybe never. In the meantime, I get to hold that money, I get to invest that money, and I get to keep the profit. Now, compare this to a normal business, or to you. If you go to a bank today to borrow $10 billion to invest, they will charge you 5% interest. You start every year $500 million in the hole. You are under pressure. You must make returns just to break even. But because our insurance operations are disciplined and profitable, our cost of float is effectively less than zero. Think about the power of that. I am effectively being paid by our policyholders to hold their money and invest it for my shareholders. This $381 billion includes a massive amount of float. It is a leverage that cannot be called by a bank. It is a leverage that does not panic in a crisis. While hedge funds are forced to sell their positions when the market crashes because of margin calls, I have a permanent structural advantage. My capital structure is designed to survive an earthquake. So when you see the cash pile, do not just see a savings account. See it for what it is, the most powerful, low-cost leverage engine ever constructed in the financial world. And I will not risk wrecking this beautiful engine by chasing a mediocre stock at an inflated price. If I hold this cash and do nothing, I win. If I invest it in a crisis, I win double. Mark Twain famously said, "History doesn't repeat itself, but it rhymes." I have been investing for over 80 years. I have seen every cycle, every bubble, and every crash since the Great Depression. When I look at the market today, I don't just see numbers, I see ghosts. I see the ghost of the Nifty 50 from the early 1970s. Back then, there were 50 companies, IBM, Polaroid, Xerox, that were considered one-decision stocks. You just bought them and never sold. They were great businesses. They were invincible. They were the future. Valuations didn't matter, people said. These companies were growing so fast that any price was justified. Does that sound familiar? It should. It sounds exactly like the Magnificent Seven of today. Take Polaroid. In 1972, Polaroid was the Apple or Nvidia of its day. It had magical technology. It had a monopoly. It had high margins. Investors were so enamored with the story that they bid the stock up to 90 times earnings. The mantra was, price does not matter for a company this good. So, what happened to Polaroid? The company didn't disappear. The camera was still great, but the valuation was a delusion. From 1,973 to 1,974, Polaroid stock fell 90%. It went from $149 to $14. In less than 2 years. Great business, terrible investment. Today, I see the same delusion. I see a Buffett indicator, the ratio of total market cap to GDP hovering near 200%. This implies that investors expect corporate profits to outgrow the economy itself forever. It is mathematically impossible. When I look at the menu today, I see wonderful companies, but I do not see fair prices. In investing, you pay a very high price for a cheery consensus. When everyone agrees that a stock is a sure thing, the price is already bid up to a level where future returns are zero or negative. I do not predict corrections. I do not have a crystal ball. But I know that trees do not grow to the sky. And I know that when the pendulum swings too far to optimism, it eventually swings back to pessimism. The swing is often violent. The music always stops, and the higher the volume, the messier the silence. On my desk, there is a book that I cherish more than any financial textbook. It is called The Science of Hitting by Ted Williams. Ted was the greatest hitter who ever lived. He knew a secret. He divided the strike zone into 77 baseball-sized cells. He calculated that if he swung at a pitch in his sweet spot, right in the middle of the plate, he would bat .400. But if he swung at a pitch on the lower outside corner, even if it was technically a strike, his average would drop to .230. In baseball, you have a problem. If the umpire calls 3 strikes and you don't swing, you are out. You are forced to act. But here is the beautiful, hidden secret of the stock market. The one concept that explains my $381 billion hoard. In investing, there are no called strikes. The market can throw Microsoft at me at 40 times earnings. I don't have to swing. The market can throw the latest AI darling at me at 100 times earnings. I don't have to swing. I can stand at the plate, bat on my shoulder, for 6 months, for 2 years, for 5 years. The crowd in the stands, the shareholders, the media, the analysts, they are screaming at me. Swing, you bum! Swing, you're missing the rally. But I don't listen to the crowd. I wait. I wait for the pitcher to make a mistake. I wait for the panic. I wait for the liquidation. I wait for the moment when a wonderful business is thrown right down the middle of the plate at a price that is so cheap it is insulting. That is the fat pitch. People laugh at me. They say, "Warren, you missed Amazon. You missed Google." Yes, I did. I missed them completely. I did not understand them. They were outside my circle of competence. But here is the truth that cures the fear of missing out. You do not lose money on the things you don't buy. I did not lose a single penny by not owning Amazon. But people lose their fortunes every day by swinging at bad pitches, by buying things they don't understand at prices that make no sense, simply because they are afraid to look stupid. How do I stay calm when everyone else is getting rich? How do I sit on $381 billion while the world parties? It comes down to one concept. It is the difference between an outer scorecard and an inner scorecard. The outer scorecard is what the world thinks of you. It is the applause. It is the headlines. It is your neighbor asking why you aren't in the latest hot trade. If you live by the outer scorecard, you will inevitably fail in investing. You will buy at the top because you crave approval, and you will sell at the bottom because you fear embarrassment. I live by an inner scorecard. If I do something that I know is intelligent, disciplined, and based on sound facts, I do not care if the entire world thinks I am wrong. In the late 1990s, during the dot-com bubble, people called me a dinosaur. They said, "Buffett is finished." I didn't argue. I didn't change my strategy. I looked at my inner scorecard. I knew the math didn't make sense, so I waited. When the bubble burst, the dinosaurs were the only ones left standing. To hold this much cash requires arrogance. Not the arrogance of thinking you know the future, but the arrogance of refusing to let other people's emotions dictate your actions. If you cannot control your emotions, you cannot control your money. People have short memories. They forget what real opportunity looks like. Real opportunity does not look like a chart going up to the right. Real opportunity looks like blood in the streets. It looks like despair. Let me take you back to September 2008. The financial world was ending. Lehman Brothers had vanished overnight. AIG was insolvent. The commercial paper market, the heartbeat of American business, had stopped beating. Corporate CEOs were not bragging on television. They were vomiting in their wastebaskets. There was no liquidity. Oxygen had left the room. That is when my phone rang. It wasn't a broker pitching a hot stock. It was Goldman Sachs. It was General Electric. The titans of American industry were on their knees. They needed capital, and they needed it now. Because I had spent years doing nothing, because I had ignored the bubble, I was the only man in the room with a checkbook. I wrote a check for $5 billion to Goldman Sachs. But I didn't buy the stock like a retail investor. I dictated the terms. I demanded preferred stock paying a 10% dividend guaranteed. That's $500 million a year, paid to me before anyone else sees a dime. And I demanded warrants the right to buy more stock later at a cheap price. I made billions of dollars in a matter of hours. Why? Not because I was smarter, but because I was liquid when no one else was. Cash is oxygen. You take it for granted when it is everywhere, but the moment it disappears, it is the only thing that matters. We are currently living in a world awash in liquidity. Everyone feels rich. But the tide will go out. It always does. And when it does, you will see who has been swimming naked. My $381 billion is an elephant gun. You don't hunt elephants with a BB gun. You need a cannon. I am keeping my powder dry. I am cleaning my gun. And I am waiting for the elephant to walk by. Panic is the only time capitalism offers a discount.
The message from Omaha is not a prediction. It is a posture. He is not betting on the end of the world. He is betting on the inevitability of human folly. He knows that greed is cyclical, and he knows that fear is cyclical. The $381 billion is not a sign of fear. It is a monument to discipline. It is a reminder that in a world addicted to speed, the ultimate advantage belongs to those who can slow down. It asks you a difficult question. Do you have the strength to do nothing? Do you have the courage to stand apart from the crowd and wait for your moment? We have only just begun to explore the depths of this mind. There are more rules, more paradoxes, and more lessons hidden in the ledger of the Oracle. We will continue to decode them one by one. If you are ready to separate yourself from the noise, if you are ready to play the long game, subscribe. This is Alpha Thought. The ascent continues.